Hello and welcome to this Tuesday's morning market briefing. We've got lots to talk about, but firstly, global trade falls at its fastest pace since the pandemic, as well as that, and possibly more importantly, the US government may well shut down going into this autumn with a compromise deal between the Republicans and the Democrats not being found on the budget. As a result, this could cause many thousands of federal workers to go home and not engage in their employment, and as a result, also have grave effects on the market and wider markets as well, such as US equities. We've got lots to talk about on the charts as well, but we'll come to that near the end, as well as lots of data coming out today on the economic calendar. Let's get straight into it and first talk about global trade. Now, global trade falls at its fastest pace since the pandemic, with world trade volumes falling at their fastest annual pace for almost 3 years in July. And this is kind of no surprise to us, really, considering how much we've been talking about China's declining economic growth, fears around the US, side of growth. And the UK's been dealing with a low growth economy for the past few years. And so it's kind of unsurprising to start seeing this, especially coming off the end of really poor German and Eurozone economic data showing, nearing recession levels in Germany and, declining in terms of, what was expected of the Eurozone economy. And how we're kind of seeing that global decline in, people's ability to purchase goods as inflation rises. So it's kind of unsurprising that trade is falling as people just don't want to import as much, and firms can't export as much because their production is falling. Now, this adds to the ever-increasing signals that rising interest rates are beginning to impact global demand for goods. Now, last week we have lots of interest rate decisions, including the Fed's decision, including the Bank of England's decision, and as well as that, the Bank of Japan's decision. Now, these results were kind of a little more surprising, with the Fed keeping rates where they were, however, signaling that there was going to be another rate rise by the end of this year, whilst the Bank of England surprisingly kept rates where they were, and having a more dovish position than we would expect. And this kind of caused mixed signals within the economy, driving the dollar higher, US equities lower, and the inverse for the pound. And so, we've been dealing with this high interest rate global economy for a while now. So it really is unsurprising that whilst rates are around, the 5.5% levels, it's unsurprising that the global economy is taking a turn for the worse, especially in terms of global trade, as people can't borrow enough money to purchase these items and trade for production purposes as well. Now, trade volumes were down 3.2% in July, which is the steepest drop since August 2020. Now, the World Trade Monitor figure followed a 2.4% contraction in June and added to the evidence that a low level of growth was, increasing. There was increasingly a situation of a low growth global economy. Now, seeming demand for goods and exports have also weakened off the back of high inflation data, which we spoke about last week, with lots of high inflation data coming out, whilst the contrary was found on for the UK. For the Fed, it was high inflation data for the US economy, and with that came the position of possibly higher interest rates by the end of this year for the Fed, and also with that the higher domestic spending that's been seen globally. And so as a result, ultimately this is weakened the level of global trade that's taking place. Money is more focused on domestic markets rather than internationally, and purchasing and selling goods internationally. As well as that, China posted a 1.5% annual fall, with the Eurozone a 2.5% contraction and the US a 6.6% decrease. And this is on trade volumes. And this is also, coming back to what we said at the start with, when you've kind of got these declining economies, or at least, contracting economies, economies facing recessions possibly, it's unsurprising that these trade volumes are, reducing as businesses are exporting less because they're producing less, and consumers are purchasing less because they just don't have the money to purchase any more. And so we see this fall in export and import levels, with most of the world reporting falling trade volumes in July. Now, rates are not expected to come down soon, and so economists expect that the lack of credit is keeping trade volumes low. Now, this is kind of unsurprising to us, really, as we've been talking about, these higher rates, which don't look like they're going to come down anytime going until maybe mid 2024, or coming to that point. And so it's unsurprising to us that these products, which generally require a level of credit to purchase, and we'll come to what those products are in a second, it's unsurprising to us that people aren't able to buy them, and trade volumes are falling because they can't access the credit for that. Now, with the lagged impact of high interest rates likely to weigh more heavily on demand for certain goods, it could be several months before global trade reaches its trough, said Arnie Curtis, who is the global economist at the consultancy Capital Economics, with the demand for goods often purchased through borrowed money being the worst affected. Now, this includes, cars, furniture and capital goods, with, I'm sure, many experiencing and understanding that, increasingly the automobile industry is relying on these loans, or even high interest rate loans, on purchasing cars. And as a result, if the credit's not there, if interest rates are too high, then individuals will struggle to be able to borrow, and as a result the markets for these products will decline, and as a result the import and export of those products will fall as well, as a result allowing us to see this global fall in trade, as well as that with furniture. So these high cost, sunk cost, certain goods, which people kind of only buy once, and so they're able to just put that on credit. Now, with demand for goods often purchased through along with the weakened growth, geopolitical issues are also affecting trade, with trade restrictions limiting trade since 2018. And this is also unsurprising to us, following decisions such as Brexit, as well as geopolitical issues around China and the US, where we've seen trade blockades, well, not blockades, but trade restrictions, tariffs, are following dumping of certain products, as well as just the general geopolitical issues around the Russo invasion into Ukraine, as well as now the mounting tensions around Taiwan with China. Now, the OECD did warn that geo-economic fragmentation and a shift to more inward-looking trade policies would curtail gains from global trade and hit living standards, especially in the poorest countries and households. And this is generally what we've seen over the years when isolationist policies have been implemented. It's these, small growing economies which then aren't able to export their goods and grow as a nation that are hit very hard. Now, as well as the industrial output, it has also been falling with 0.1% compared to the previous month globally. And this has kind of been caused by sharp falls in output in Japan, as well as the Eurozone and the UK. But despite that, however, the US industrial output was up by 0.7%. So it's not all doom and gloom for the global economy and global trade. However, it is looking pretty bleak in relation to these high interest rates, and as a result, lack of credit to purchase and export certain goods. But moving on from that article, here's the article which you've all been waiting for, really. It is that, lawmakers warn that the US is heading for a shutdown as budget talks stall. Now, this is in relation to US lawmakers warning that the government shutdown is increasingly certain as hopes dwindle of the last ditch compromise to resolve a budgetary standoff in the world's largest economy, that being the US economy. Um, now, speaking on Sunday, both Democrats and Republicans said time was running out for a deal on October 1st, with if no deal being reached, a shutdown will occur, forcing thousands of federal workers to stay home and paralysing vast swaths of the US government in a way that could hurt households and businesses whilst damaging the American economy. Now, this is kind of coming off the back of, the issues within the Republican Party around the kind of more pro-Trump hardliners, whereas the more, pragmatic and, centrist Republicans in the Senate and the House. And as a result of the issues within the Republican Party, it does seem that a compromise on the US budget is failing to be met. Now, hardline Republicans and allies of former President Donald Trump are now blocking a new fiscal compromise. And, this is not the first time we've sort of seen this result come out of, a budget discussion with, countless years, including during Obama's presidency and Trump's presidency, there being, government shutdowns where, federal workers have been left to go home until the budget is resolved and people can get back on payroll and start working. And every single time this does occur, it does cause large issues for the global economy as well as, US markets in particular. With McCarthy in recent days floating a 45-day extension of government funding in order to give more time for an agreement on the details of spending, but still is facing resistance from those hardliners within the party. And this is kind of the compromise and, situation that McCarthy does have to deal with as being, one of the more centrist-leaning members of the Republican Party, is he's got to find a compromise between the Democrats and somehow with the hardline Republicans. And that's obviously a tough job for anyone, bringing two parties with, staunchly different ideological positions and trying to get them to agree on a budget with, there kind of being now political incentives for the hardline Republicans to block this budget going through. Which will come to near the end, with Joe Biden on Saturday night warning that the shutdown could jeopardize military pay, food safety, early childhood education programs, and cancer research. Because we have to remember, every single time these federal shutdowns do occur, it is thousands of federal workers which do go home and do not work for days, reaching, a month even. So it can have vast and detrimental effects on the bureaucratic processes of government, which are already, in positions of, long and, over subscribed sort of situations and that sort of thing. Due to the standoff coming at a time where Biden is dogged down by a low approval rating, and that's especially on the economy, the White House could face repercussions politically in an extended shutdown. And this would largely, come from individuals seeing, a lack of ability to control, the Senate and the House, and kind of cause this untrustworthiness of Biden, as well as the issues that it could have on the economy if a shutdown does occur. Generally, the blame is just placed on the president, despite who might have actually caused the shutdown. With Pete Buttigieg telling NBC on Sunday that the most frustrating thing, of course, is that the president, the administration, have the responsibility to make sure, no matter what Congress does, that the country continues succeeding. And that's kind of the issue which every president does have to face, is this kind of issue of, whenever a large political issue does pop up, it's the president's job to continue pushing through with that. And there is still a chance of an intervention, however, by centrist lawmakers of both parties in the House, or even a deal forged by Senate leaders, which might put pressure on the lower chamber to accept a compromise. But that's all for the articles. Next to talk about really is the charts, with the first to talk about really being indices. Now, talk about US indexes for quite some time, in US indices for quite some time, and generally, coming off the back of the Fed's decision to keep rates where they were, but talking of raising rates later this year, we saw US indices and US stocks sell off as they anticipated these higher borrowing costs affecting the economy. And as a result, we kind of saw this large fall off, breaking prior lows made in August. And nearing this prior area of liquidity. However, it does seem that it's kind of bounced back before reaching this area of liquidity somehow, and is now on the move to the upside. So it'll be interesting going into this week to see how US indices kind of price in, and whether they'll continue lower to this area of liquidity, maybe after touching an area on the Fibonacci retracement chart. Now, that's also seen across all other US indices, such as the US 100 and the S&P 500, which have broken below this prior area of liquidity and now are retesting it. Next to talk about really, though, is the dollar, which has made new highs. I know yesterday we were talking about how the dollar was kind of consolidating after breaking this prior high, but it does seem that following the Fed's rhetoric last week, it is continuing to push higher off the back of the rhetoric around keeping rates where they are, but raising rates later this year. And it still does seem that the dollar is pricing in that rhetoric and moving higher as we speak. As well as that, Euro USD has broken lower, breaking below this area of prior support and area of liquidity. And this was the area of liquidity that we were talking about for ages, and it did end up sitting around that area and failing to break lower for some time. However, now it does seem like it's broken below and is now making new lows. In terms of whether it might retest this area of liquidity before heading lower, if we stick on the Fibonacci retracement tool and just pull up the 38.2 fib, as we can see, it lines up perfectly here, and it does seem like this would be the area which it might retest before heading lower, if it does retest at all. But moving on from Euro USD, we've got GBP, JPY to talk about. As we said, based on the Bank of England's decision, as well as the UK's inflation data, the pound did break below this area of this channel, and has moved lower and touched this area of liquidity before moving higher again, and retracing to this 50% fib, where it's gained liquidity again, ready to move to the downside. That said, it hasn't moved to the downside just yet, and it does seem to be consolidating around these two Fibonacci areas, where it doesn't seem like it's been able to break out yet. So it'll be interesting to see whether it will continue to move lower based off getting this liquidity earlier on, or possibly it might now move higher just based off the pound being priced in following last week. As well as that, we've got USD JPY to talk about, which is making new highs. We spoke about the possibility of a double top forming here, but it didn't. It broke above, continuing higher, and now it's interesting to see whether it will retest this prior area of liquidity, this prior high, and then hit the 38.2% fib before possibly moving higher. We'll see what happens with that. As well, to talk about is Bitcoin, which we kind of were looking bullish on, but as we said yesterday, it was breaking lower, and now it seemingly has broken back into this range which it was sitting in for ages. So it does seem that this was once again just a massive false breakout, similar to these prior areas such as here. These are all false breakouts, and now the pound, the Bitcoin is sitting once again back in this range, and so it'll be interesting to see now it's broken back in, whether it will retest this area of liquidity, retest this area of once support, now resistance again, and possibly move once again to the lower side of the market around the 2555 area, 25583 area, sorry. But moving on from Bitcoin, gold is really the one to talk about. I warned yesterday, and I kind of said, it's looking like short positions will be taken on gold based on the fundamental data that we received last week around, the negative, the positive news for the dollar in relation to raising rates later this year, as well as the reduced geopolitical tensions between China and the USA, which I kind of culminated in a fundamental picture that was negative for gold in the short term. And so I kind of said that I would expect a fall off from this 38.2% fib, and that is what we've seen from gold. It'll be interesting to see whether it will continue lower, possibly to these prior areas of liquidity around the 78.6% area. But that's all for the charts. Next to talk about really is the economic calendar, with lots of, not so much data coming out today, but firstly, the Aussie conference on inflation. So that'll be very important to kind of looking forward and seeing what the RBA may decide on the next interest rate. And any inflation news really has great effect on the currency itself. So if you're trading any AU pairs, obviously keep your eye on that. As well as that, we've got US house price index figures coming out, which obviously will have a great effect on interest rates, along with US consumer confidence data, as well as US new home sales and a Fed official's speech. So not too much data coming out today. Lots of US kind of housing data, and a lot of interest and interesting data coming out around the US as well as Australia. But that's about it for the economic calendar. Hope you have a great trading day this Tuesday. Have a great one. See you later. Bye.